Fear on the street and beyond it. Stocks nosedive. The Dow falling 265 points. The market's on an 8-day losing streak. Washington's debt deal proving no relief.
The uncertainty surrounding the raising of the debt ceiling has been unsettling.
Investors already moving to the next crisis. A limping U.S. economy, a crumbling European Union, and a growing slowdown in China. The question now, is your money safe? The answers tonight on this CNBC special report. Markets in turmoil.
You can see very clearly then if we are not shipping and hauling as much as we were because the U.S. and global economies may be slowing down, and soon because of Washington's spending cuts, we won't be fixing as many roads, bridges, and building anything big. Is this recovery in serious jeopardy? Joining us now is Mark Zandi, Chief Economist at Moody's Analytics, and Marilyn Cohen, President of Envision Capital. All right, Mark, I want to ask you this. Our viewers are watching the S&P down 7 days in a row. They're watching Europe tank. They're watching Brazil start to slow. Give us a reason to be optimistic about the U.S. economy.
Well, American companies are very profitable. Their margins are about as wide as they've ever been. And
they're not hiring.
Earnings growth is very strong. And that is due to, in my view, a lack of confidence. They're very nervous. And hopefully, on the other side of this debt ceiling drama, we'll get some confidence. You mix that in with the good profits, and we'll start to get some hiring. And that's the key to everything. If we get more hiring, we'll get more job creation, income growth, and we'll be off and running.
It makes it sound so simple if we just get some more hiring. But Marilyn, are we going to get some more hiring? I mean, where's that going to come from, especially in an environment where the economy is sputtering along and we're also staring down the barrel of less spending?
Well, I think the CEOs of corporate America are breathing a sigh of relief, like, wow, I did the right thing in not amping up and hiring and building out my business even more. So I think that this is going to be verification of they're going to hold on to exactly the same kind of business model that they've done the last couple of years and stay lean and mean. So I'm not optimistic about hiring.
Well, Mark, yeah, we can sit here with the job situation, and we obviously know that the economy, I mean, this is it. If there are no jobs, if the job growth isn't there, if we see GDP growth, what do we do when we have GDP numbers that essentially we can't trust at this point?
Well, every business cycle since World War II has been very similar to this one in this following sense, that you get to this chicken and egg point where businesses have seen, they've cut costs, they've improved productivity, they've gotten their margins up, they've got earnings growth going, they got their stock price up, and at that point, they need to take a leap of faith and say to themselves, look, I can't continue to cut costs and grow earnings. I got to look for revenue opportunity, and that means I got to take a chance, and I got to go out and invest and hire, and we're right at that point. Now, I do think that that process has been obviously attenuated and almost short-circuited by all the difficult things that are going on around us, most recently the debt ceiling drama. But hopefully, we get on the other side of that, they'll gain some confidence, and this normal dynamic that we see in the business cycle will start to take hold again. So that chicken and egg problem is always a problem, but hopefully we'll solve it in the same way going forward.
Marilyn, at the end of the day, stocks are just a measure of future earnings, right? I mean, fundamentally, that's all they are. So the last 7 days with the S&P down, the market is saying we see earnings growth slowing down. They see the economy perhaps slowing down. Is the wisdom of the crowd, i.e. the market, right?
Absolutely. The market is the master, and that institutional investors, like you're talking about, are losing confidence that revenues are going to be deteriorating, earnings are going to be deteriorating, which means stock prices are going to go down even further. And I think the market is speaking to us and telling us that, we've had 2.5 glorious years of great earnings, great stock prices, and now it's time to take more than just a moderate breather.
Quantify that. If you say, Marilyn, the stock prices are going to go down even further, how much? I mean, are we looking at a serious bear market here? Is this just a correction? I mean, quantify it for us.
Hard to do, very difficult to do. I would say we're probably in for a correction, and the bond market has been telling us, hey, we're in an economic slowdown. Everybody who had been anticipating higher bond yields, including me, everybody who had been anticipating that once QE2 was finished, we were going to fall off a ledge, turned out to be wrong, because that's where the safe haven trade has been, buy bonds from 1 year to 30 years, and that's why we've had such an unbelievable rally to today particularly.
Can I just follow on here, because we've just been discussing the fact that the PBOC, the Chinese central bank governor, has come out and said that he believes that the U.S. needs to take more concrete and responsible actions, and if they do that, then they would see more confidence in U.S. Treasuries. They are, if I'm not wrong, the largest holder of U.S. Treasuries. This is kind of like a little shot across the bow, wouldn't you say, Marilyn?
It is, and it isn't the first shot. Thank you for pointing this out. They have said things like this before, very gentlemanly, very eloquently, and somebody needs to listen, because the cutbacks that are the abracadabra cutbacks that Congress just passed really are not what the Chinese are looking for. And if we don't want to see higher rates, which we don't want to do, we better listen to them and get our fiscal cuts in order, real cuts, not the make-believe cuts that we're going through right now.
Absolutely. Marilyn and Mark, thank you very much for your commentary. We're coming